What's up, apes, and welcome to Bizarro World, where market concentration turns out to actually be a good thing, and inflation is no longer growing, but is actually deflationing. So we're going to be talking about all that stuff in just a quick second. We're also going to be getting into some major stock moves of the day, talking about why the richest man in the world just became even more of the richest man in the entire world. Tesla shares were up. We had a bunch of other shit that was down. Dave and Buster's was down for the day, which I think is the most un-American thing imaginable. But let's go ahead and get right into it. The WSO Alpha portfolio did have a rough day. We were down about 44 basis points thanks to some heavier losses and, of course, for being less exposed to the semiconductor industry than the S&P 500, which we still think is going to work out in the long term. But, on these day-to-day fluctuations, it's very tough to make the call. So I'm going to go fire some of the apes over there, and then Patrick's probably going to fire me, and we'll see what happens afterwards. But let's go ahead and get into the banana bits here today. So first and foremost, we also got the initial jobless claims here report here this morning, and this basically said that Americans haven't been this jobless in about 10 months. So we officially hit the highest rate of initial jobless claims ICJ filings since August of last year. So it's kind of wild to see, but it fits into the falling inflation, slowing GDP narrative. We'll get more into it in just a quick second. Meanwhile, Saudi Arabia is ditching its dollar exclusivity. So prior, the petrodollar agreements basically ensured that Saudi Arabia would always be trading trading oil exclusively in US dollars, even if it was with China. Like Saudi Arabia and China would use the dollar to trade oil, and that is no longer going to be the case. They are opening up to the RMB, the yuan, the yen, and the euro. So a bunch of other countries getting involved there. We also see that basically Adobe shares took flight after hours. Very strong earnings report for the technology company. Definitely go ahead and check that out. Growth in restaurant spending is starting to move in the right direction once again. It fell about 2.4% in April, but was up about 1.9% in May. So shout out to Bank of America for doing the Lord's work and making sure that we're all still getting drunk and fat. Anyway, a megaport, speaking of China, is being built by China in Peru, and it is scaring the absolute shit out of the United States. We also just found out here late after hours that Elon Musk, shareholders of Tesla, did approve his $56 billion pay package. And that means that this graphic I'm about to show, this is the Bloomberg Billionaires Index. This is no longer accurate because this shows Elon, who is already the richest man in the world, at $207 billion. Add $56 billion to that, I think that's how it works. It might be a little bit more complicated than that, so fuck it, let's just call it $250 billion. He is still the richest man in the world, despite being down $22.5 billion this year. Meanwhile, number two, Mr. Jeff Bezos is up $29 billion this year. So basically a $50 billion spread trade. Bezos is winning, but Elon is still on top. And then a Bernardo Knowlton, Mark Zuckerberg, Larry Page, Bill Gates. Pretty much everybody. And the last one you see on here is the richest woman in the world, Mrs. Francois Bettencourt Myers. I'm pretty sure she's the heir to the L'Oreal fortune. I could be mistaken on that, but either way, very interesting development on that front. Elon is getting his payday. All right, moving on into the big story of the day. We are, of course, talking about the PPI report. So yesterday or on Wednesday, we got the CPI report. That's consumer inflation. Today is producer inflation. PPI, not just the last three letters in the word Mississippi, it is also the producer price index. We actually saw, believe it or not, drum roll please, a 0.2% decline in monthly PPI from April to May. So obviously investors were pretty hyped up to see that. It fits very much into the narrative that Jay Powell was espousing yesterday, talking about why the Fed hasn't really made any changes just yet. The explanation is because shit's working out pretty well already. Like, why would we do anything different if everything is still moving in the right direction? Might be moving a little bit slowly, but what Powell has been big about during his tenure as Fed chair is commitment. When he commits to doing something, he goes big into it. We can see that with the money deployed during the COVID pandemic when that all started, and he dumped trillions and trillions of dollars at banks and individuals across the United States. We can also see that in the interest rate hikes. He was going through the moon, literally said, we're not going to do anything beyond 25 basis point hikes. And then he did 375 basis point hikes in a row. This guy commits when he does something. He doesn't do it half-assed like Ben Bernanke or Janet Yellen did. He is full throttle, pedal to the metal kind of guy. And so why would we change anything when it's working out already? We can see that right here, that slight decline in this black line over here at the very end. Now, if I go to the annual rate of PPI, we can see that it is still increasing, but it is up by 2.2%, which if my math is correct, that is more than 0%, but it's only about 10% above the Fed's inflation target of 2%. Keep in mind the Fed target's 2% because 1% is too low and 3% is too high, obviously. I mean, nothing makes more sense than that. Effectively, the biggest contributors to the downpull in Producer inflation for the month was energy. Energy prices were down 4.5%. So obviously, analysts were pretty hyped to see that. Energy prices falling is kind of a shock as well, considering all the tension going on in the Middle East. So nobody was really expecting this going into this year. Everybody kind of thought, oil prices would be spiking, especially at the end of 2023 after the attacks of October 7th. But that is definitely not what we're seeing right now. Transportation services were also down very much. And that fits right in line with the 0.5% decline seen for the month of May on the consumer side of inflation. So all in all, it was a very good looking report. Basically, the big takeaway of the day, we can go ahead and find that in the 2-year Treasury notes. So if we take a look at this chart right here, this is the path of 2-year Treasuries for basically the last week or so. They spiked coming into the week on expectations for worse than expected inflation reports, but we in fact got the opposite. So we did this leg lower in response to the CPI report, and then boom, a big drop down in response to the PPI. So obviously the bond market, quote unquote, the smart money, we all know the real smart money is in GameStop, right, Mr. Keith Gill? But the real smart money, fixed income assets, are betting on a lower path for interest rates going forward. As we like to call it here at the Daily Peel Global Headquarters, we are looking at things being lower for sooner. The higher for longer narrative doesn't seem like it's going to be around too long, especially when you consider that we're seeing literal deflation on the producer cost side of things. We are seeing slowing GDP growth, slower consumer spending growth. Maybe that data comes into question now, especially with that restaurant data that I mentioned earlier from Bank of America. Increased restaurant spending, very discretionary expense, so that bodes well for overall consumer spending. But we're also seeing those initial jobless claims spike. So I'm very excited to see the June employment report because May came in extremely hot. That could have been an anomaly. We'll find out in a couple of weeks. Meanwhile, let's go ahead and move on into some of our big stock movers of the day. So first and foremost, we have Broadcom. This is a super boring chip company, but it's one of the biggest ones in the world. They also bought VMware last year or 2 years ago, $69 billion, very nice $69 billion acquisition there. And apparently it was a good one because VMware is already contributing to sales growth as well as earnings growth on an accretive basis. We also saw AI sales added about $3.1 billion to Broadcom compared to the year ago period. Sales in total were up 43% annually. They absolutely crushed it on the sales and the earnings side. Shout out to Broadcom for a very strong earnings report and for a 12.3% day. Next up, we have Tesla up 2.9%. The stock basically rose because shareholders once again agreed to Elon Musk's pay package that they already agreed to in 2018. This is making him even more of the richest man in the world, which is absolutely ridiculous. It's completely unfathomable that this guy is getting an additional $56 billion and he can't even give me $1 billion. I mean, that just seems a little bit rude of him. But either way, he's going to be somewhere around the $250 billion mark once that distribution of ownership actually goes through. Keep in mind, Musk has not taken a salary or any compensation from Tesla since 2018. He's actually never taken a salary. It's been entirely equity. So he's got that risk side of it. He also hit these milestones that were virtually impossible or seen as virtually impossible back in 2018. 10xing market cap, 350% growth to revenue, ridiculous growth to EBITDA, EBIT, and net income. So kind of deserves it, but it is an absolutely ungodly amount of money. But hey, this is what shareholders agreed to a couple of years ago. Why should a Delaware court, why should a third party come in and be able to say, no, actually, this thing that you guys agreed to, we're not doing that anymore. That is a parent's job, and these are adults. So you reap what you sow. What else can I say? Moving on down below into Virgin Galactic. I mean, this company, they could call themselves Virgin. It should be Incel Galactic because, Jesus Christ, they are involuntarily moneyless, and it's one of the most embarrassing things I have ever seen in my life. This money Virgin, it was even worse on the day because basically, Virgin Galactic came out and said that they're going to be enacting a reverse stock split, which is, believe it or not, the exact opposite of a stock split. So in a stock split, you are effectively issuing more shares, or you're saying that you're basically, like, say you hold 10 shares at $100 a piece. If they do a stock split, you're like a 10-for-1 stock split, you will be holding 1 share or 100 shares at $10. Basically, that's how it works. And then a reverse stock split is the exact opposite. So they are doing a 1-for-20 reverse stock split. So that means for every 20 shares you own, you're now going to be owning 1 share in Virgin Galactic or SPCE. They're basically doing this to artificially inflate their share price above the $1 minimum that the New York Stock Exchange and the NASDAQ both have. Basically, if your shares are trading below $1 for more than 30 days, you are going to get delisted. So Virgin Galactic is apparently approaching that, so they're going for the 1-for-20 split rather than actually creating some kind of business for themselves. Anyway, Dave & Buster's down 10.9% on the day. I mean, holy shit. How are we going to abandon this mecca to obesity and gambling? That's everything that America stands for, right? Those are the two most important things. When George Washington founded this country, that was what he was all about. So it is what it is. The company had a very, very tough earnings report. They actually missed earnings estimates by 42.8%. Came in at 99 cents a share versus, I think it was $1.79 that was expected. So very weak earnings on that front. Also very weak in terms of inventory management and other elements involved in their cost structure. Basically, nobody's playing their arcade games anymore. It's a bad time for consumer inflation. Maybe things are turning around in June based on that data that we got from Bank of America. Either way, very tough to see for a great American brand like Dave & Buster's. Finally, moving on down into our thought banana for the day, we are talking about stock inequality. You know, everybody's always saying the stock market is too high. Companies don't pay enough taxes. They don't pay any taxes. AI is in a bubble. It's enough already. Somebody needs to stand up for these poor, sweet, trillion-dollar corporations that can't speak for themselves, and I am here to do that. We're always talking about how they're doing, but nobody's ever asking how they're feeling. I mean, come on. We got to look into this thing. So I'm here to defend them and talk about why mega cap corporations being very concentrated and leading the entirety of the market is actually a good thing. So if we go ahead and look, thankfully, somebody else actually gave me some data to base this absolutely ridiculous take on. So let's go ahead and see if we can get that pulled up. What we're looking at here is stock market concentration in the United States over time. So what we're seeing in this kind of lighter blue line down below, they actually use like WSO colors. That's pretty sick in this. I didn't change these colors at all. But in this WSO blue color down below, that is the biggest stock in the world, which right now is Microsoft. Could switch back to being Apple relatively soon, but it is Microsoft for now. Then we have the top three. That's going to be Microsoft, Apple, and Nvidia. Then we have the top 10 up at the very top. So pretty much all these were at or near all-time highs. That on its face is a little bit concerning because the whole point of investing in an index fund is to get that diversification. But if over a quarter of it is in 10 stocks, you're not really getting that diversification that you would want. But take a look at this chart right here. This is essentially plotting annual returns during rising and falling concentration periods. So what we're seeing is that pretty much every time concentration is rising, the market is also going up. That is very surprising data. There is a little bit of variability that we can see in periods like here, periods like here. So, you know, obviously no data series is going to be completely perfect, but still this suggests that market concentration is actually a pretty good thing. And if we look at something like Nvidia, we can start to understand why. The stock has contributed to 34.5% of the S&P 500's total return for the year so far, which sounds absolutely ridiculous. One company is picking up more than a third of the index's returns. Come on now. But when we take a look at the earnings performance, especially the earnings performance relative to the share price, we can see that the company is actually getting cheaper. Try to ignore the moon that you're seeing up over here. That's way back in time. What we're seeing is Nvidia's last 12 months price to earnings report. So this is actual earnings, and we can see that it has been nothing but on the decline for the last year. So the stock has actually gotten cheaper despite running up so much when we're talking about things on an earnings basis. So long story short, market concentration actually tends to work out, and it seems like it works out especially when the companies that are, doing the concentration actually have the fundamental performance to back it up. Like anything in markets and macro, it's going to take more than one piece of data to come to any worthwhile conclusions. We're just kind of wondering right now how long this run can last for the Mag 7, what companies are going to be the next Mag 7, and when is that going to happen? If that happens whatsoever, I mean, Nvidia, Microsoft, Apple, you'd be hard-pressed to bet against those guys. Anyway, let's finish it up with a quote of the day from everybody's favorite shark on Shark Tank, and the owner of the NBA team that is about to get absolutely smacked by this man right here in Game 4 in just a couple of days, Mr. Jason Tatum. I'm going to hold him up while I read this quote because it is from Mr. Mark Cuban. He said, "The best way to predict the future is to invent it. But when it comes to blue chip stocks, the best way to protect your future is to invest in it." So obviously, who's inventing the future? Obviously, Jason Tatum is by already giving the Celtics a championship this year. I mean, it's been priced into the team for quite some time already. But Mr. Cuban is also saying that, investing in blue chip stocks is kind of the way to go. Feeds back into our market concentration discussion. Anyways, apes, that about does it for me here today. It is now 7:46 p.m., so we'll see what I get up to with the rest of my hour and 15 minutes before my bedtime hits. Anyway, thank you all for tuning in once again. I was going to say see you tomorrow, but I'm actually going to see you on Monday again, so try to keep yourself held over until then. I don't know how you're going to survive, but definitely the best of luck. Let us know if we can do anything. Always feel free to reach out. Happy investing, happy trading. Bye now, apes.